This might be the most important video that you ever watch on investing. Now, I'm going to be talking a little more candid and real in this video, but the reason that I'm doing it is because I'm tired of watching people miss an opportunity and some of the easiest opportunities to generate wealth. The stock market is the greatest wealth generator that we have. Not real estate, not an econ business, not some sort of side hustle. Nothing can match the sort of wealth generation as the stock market, right? Right now, we are down 1.9% from all-time highs as of the time of this recording, okay? Just a week and a half ago, people were panicking. The VIX hit above 70, and we were hearing from a ton of big accounts online as to why we should not be investing in the stock market. Do you know what we did in that same time frame? We bought the semiconductor ETF SOXL, which is up 70% in that short amount of time. Nvidia is up almost 40% in that short amount of time. This is 3 times what you would get from the average stock market yearly return. The TQQQs, which is a NASDAQ leverage ETF, is also up around 41% in that short amount of time, that week and a half since the mass panic. Now, why am I saying this? I'm saying this because, like I said, I'm tired of seeing people miss opportunities. Now, I went to finance school, right? A lot of you watching this didn't. So I'm going to break down exactly how it is that I view these types of investments, how it is that I view really the mass hysteria in the market, the mass panic in the market. What types of data do I look at? How do I determine when is it a good time to enter the market? How is it that I stay calm? A lot of you have been commenting and thanking me on the last 4, 5, 6 videos that I've done during the volatile time period of August, keeping you guys sane and keeping you really looking at the prize, not missing the forest for the trees. So I want to break down some of the statistics that have allowed me to remain calm and sane. And when everyone's panicking, thinking of selling or buying puts or whatever, how it is that I start loading up on opportunities at the right time. And no, this has nothing to do with catching the bottom. Let's just get right into it. As I said, this is going to be more of a candid video, but why the stock market is the greatest investing and wealth generation tool that we have, and how so many people get it wrong. Hopefully you learned something out of this, and if you do, let me know what is your favorite thing that you learned out of this video in the comment section. If you learned nothing, tell me as well. So let's just get right into it. So number one, the statistics on market pullbacks. Now, this is all stuff that you can Google. Like I said, hopefully this gives you some idea of what to look for the next time that the market is in a pullback, correction, or bear market, or just if you are thinking of investing at a random time. I'm sure you will get some gems out of this. But on average, there is a 5% decline in the stock market, and this happens an average of 4.5 times a year in the S&P 500 since 1980. And when I looked at the S&P 500 this year, we've only had one pullback, which was in April of 2024. We pulled back around 5%. We haven't had one since. So this one right here, right, would be the second time that we pulled back by at least 5%. Now, for those of you that don't know, a bear market is categorized by a 20% or more pullback, which is actually a very rare occurrence. It happens around once every 5 years. Again, these are just statistics that I find on Google. Now, corrections of 10% up to 20%, so not yet a bear market, are even more rare, right? Pullbacks, you get around 4.5 a year. Corrections are even more rare than that, right? You average about 1 correction every 2 years. However, you can easily, again, Google, how does the stock market perform after corrections? Look at this. Some of the best returns are had after corrections. As a matter of fact, just based on these stats alone, you can probably formulate a strategy off of loading into the stock market during corrections. So this recent pullback, which almost hit correction territory, it was like 9.5% on the SPY. When you're looking at this, right, when everybody here on August 5th calling it another Black Monday, oh my God, this is a Japanese bank crisis, right? Or a Japanese currency crisis or whatever. When everyone's panicking, if all you had was information, was access to the information that I just showed you, this right here, like I said, you can formulate an entire strategy off of 10% corrections. If all you did was bought during 10% corrections, your gains would actually be more than someone who just regularly buys into the market during non-correction times. Now, again, here I'm talking about investing, although like I said, once you get savvy, you can formulate swing trading strategies based off of this, but I'm just talking about investing here. You don't need to be a day trader, a swing trader, or anything. And the great thing about this is that you don't have to be that right? All you're doing is investing in something that is discounted. So even if the market continues to correct a little bit, it doesn't matter. You still got a great price locked in for the long term. And this is what baffles my mind, is that people, you have these big accounts on Twitter or on YouTube that try to dissuade people from buying major discounts in blue chip stocks and indices, when clearly the data shows that is actually when you should buy. More data for you. Only 5 market corrections since 1974 have actually become bear markets. So rarely do corrections actually turn into bear markets, which is crazy, because every time you get a correction, you get all these people saying, this is it, this is the big one. Guess what? They are likely wrong. They are likely wrong. I don't care who it is. I don't care how big the account is. I don't care how big the portfolio manager is. They are likely wrong just based off statistics alone. Numbers don't lie. Another thing is, it helps to know historical precedents based on previous events that might be similar to what we're seeing now, right? Now, if you don't have an extensive market knowledge, obviously you can start Googling this stuff. Like, for instance, when was the last time the VIX spiked because of something that happened in the Asian markets? Now, on August 5th, which was the day that there was mass hysteria about the Japan carry trade, right? I basically said this on Twitter. By the way, follow me on X for free daily trading and finance content there, and Instagram. I post there daily. But I said that this reminds me of August 24th, 2015. We were coming off a record high, just like we were on August 5th, going into recession fears, just like we are now, and the NASDAQ corrected by dropping -8% in a couple of days, ending on a Friday, right? And then August 24th, 2015 was a Monday, very similar to August 5th, 2024, which was a Monday. So on Monday, August 24th, 2015, the market opened severely red and the NASDAQ threatened to close into bear market before being bought up at the end of the day to avoid it. Now, one other thing that I noted here, and the reason that I was looking at this was because we saw a VIX spike, a volatility index spike, very similar to what we saw then. And coincidentally or not, this was the actual bottom. That day of the mass hysteria was the actual bottom. And this is what I think a lot of novice investors don't get, or frankly, even experienced investors, they don't get that, when we have mass panic on a single day, you are much closer statistically to a bottom than a top. Now, I'm not saying that, in bear markets, if there's a mass hysteria, I'm just saying in a market that is in a bull market where there's a mass hysteria and a spike in the VIX due to some outlying event, on that day that the VIX spikes to levels that we haven't seen in years, just like we recently saw, you are probably closer to a market bottom than a market top because of that mass panic causing that quick drop in the markets. As a matter of fact, here I said Black Monday. Since we're on the topic, let's talk about it. I said it took stocks 1 full year to get back to the high of the day on the Black Monday crash of October 19th, 1987. However, here's the important thing that people always miss. If you bought the bottom on the day of the crash, you were profitable the very next day onwards. You might not believe me. Go back and look at the SPY. October 19, 1987 is considered one of the worst days in stock market history. And if you bought on the bottom of that day, you were never red following that day. That's insane, right? Now, if you didn't do anything, it took you a full year to recover your losses. Let's look at it. Here's the infamous day right here, October 19, 1987. If you bought the bottom of this market, you were never red. Not only for the short term, ever again. If you bought the bottom on October 19th, 1987, for the rest of your life until current day, until 2024, you were never red. So this is what I'm saying. When we have peaks of mass hysteria on a singular day, you are usually closer to a bottom than a top. Now, if you didn't do anything, or even worse off, say you bought in August 1987 at the all-time high back then, but if you didn't do anything, it took you an entire year before the market got back to the level before this crash, right? If you look here, we did not recover back to the high before the drop on October 19th until October 1988. And we didn't get back to all-time highs at the time was in August 1987. We didn't get back to all-time highs until July of 1989, so 2 years later. However, if you started buying in the correction, you amassed, not only were you profitable, you amassed so many gains in such a short time. It's unfathomable. But you could have only done that if you bought the peak fear. Just like this. You have the stats to prove it. Don't take it from me. Look at the numbers. Google it for yourself. try to refute what I'm saying if you don't agree. And I just want to pause this and real quick and say, if you're watching this before September 1st, we are doing a free trading mastermind. You have to be on this list if you want to sign up. September 1st at 12 p.m. Eastern time. It's a Sunday. Make sure that you sign up. If you sign up, you will get the recording of this as well. I'm going to be teaching it live. It is not recorded. So if you want to learn how to trade, if you want to learn how to day trade, again, this video is not on day trading, but if you were interested in also learning how to day trade, get your name on this list. It is absolutely free. I'll see you guys there. Now, what are some other things that I looked at, as if what I showed you isn't enough, but let's just keep going through it. Like I said, I'm going to keep giving you gems. My interest is in making you guys into the best investors, or at least the best searchers of investing knowledge that you can be. I want you guys to take a look at all this stuff. You know, when I looked at what are the markers for a recession, the 10-year, 2-year treasury yield. When I look at this, every time it inverted, when it uninverts, we get a recession. This gray column here, these gray columns are recessions. We are not yet uninverted, but we are very close. However, the 10-year 3-month is also an important spread. That needs to uninvert also. It's not just enough that the 10-year, 2-year uninverts. The 10-year 2-year has to uninvert. The 10-year 3-month has to uninvert. The 10-year 3-month is actually going down, meaning it is not steepening. This is the other way that you want to go, you know, before we see a recession, right? If this was climbing up towards the 0 mark and potentially uninverting, then I will, you know, start to get a bit worried. But we are actually very far from this, according to this metric here, right? We are very far from uninverting. We haven't yet uninverted on the 10-year, 2-year. For me, both of those things need to happen before we even declare a recession. Now, when I look at the high yield index, what this index is, high yield bonds are basically what we call junk bonds, right? They're high yield because they're a little riskier. When you look at this index here, I don't want to go into it exactly what it is, but it's basically comparing junk bonds to non-risky assets, right? This tends to go up. This tends to curl up drastically before we get a recession, right? As it becomes more risky to invest in junk bonds or high yield bonds. You see this every time, this sharply rising before a recession. We are still flat. We are not at threatening levels on the high yield index. Another piece of data that I have for you that I shared in our trading floor on the day that we actually started buying stocks. And if you want proof of this, I started buying Nvidia, SOXL, Amazon, NASDAQ, etc. Here you can see the date August 5th. That's neither here nor there. But another piece of important data is to know actually how long do bull markets typically average. And if you look at this, and I shared this with the trading floor, I also shared this on Twitter, by the way, the average length of a bull market is a lot longer than you think. Right now, we are running on 22 months. And as I said, if the bull market were to end today, or were to end in August, it would be the second shortest bull market in history. On average, bull markets last 61 months. That is 5 years. On average, bull markets last 5 years. This isn't going back to 1980 or 1970. This is going back to World War II. On average, bull markets last 5 years. So I did not think that just based on the panic of one day, we were all of a sudden going to get a bear market, right? That to me was extremely unrealistic based on the statistics that we have. And the stock market's been around for 100 years now, right? It was just extremely unrealistic that would happen. Now, one thing that I was interested in looking at is, okay, is the stock market overvalued? We've already had a large number of earnings come in, right? As of the time of this recording, we still don't have Nvidia earnings, the last of the Magnificent Seven to report. They report on August 28th, but in the, you know, I was wondering how expensive this is the stock market. That's an important question to ask, don't you think, and to answer. If you look at the PE ratio, the 4 PE ratio of the S&P 500, this is basically the price over earnings of the entire S&P 500. So if it's inflated, obviously then it's going to be a higher number because the numerator is going to be the price of the S&P 500, or the price of the stocks in the S&P 500. So if you look at this, the PE ratio currently is actually pretty average. right? Which means that all of these earnings that are coming in just killing it, the stock market still has room to grow into these valuations long term, just based on this forward PE ratio, right? We are currently dealing with around a 21.5 forward PE ratio. Now, when we look at previous recessions, so for instance, the recession before 2020, we were over 26. When we look at the 2008 recession, we were already above 32. So the stock market was so overvalued back in 2008. The stock market was so overvalued, or not so overvalued, but more overvalued before 2020. And right now we are still in this pretty average range here of 21.5. Now, what about election year, right? Don't we think it's important to look at the seasonality of the S&P 500 during election years? August has been green 100% of the time in an election year for the last 32 years. As a matter of fact, it is the only 100% green month. Doesn't mean this will be the case all the time. No, but we aggregate all of this data that we have, that I presented to you, and we put it together and make the most informed decision. That is just another piece of important data there. One other thing that I like to look at is the VIX over VIX 3-month. This right here is an index. If you type in VIX/VIX3 in TradingView, you'll get this, right? So this is the current VIX over the projected VIX in 3 months. So obviously, the further in the future that we're trying to project, the higher the volatility is going to be, because we don't have the information about what's going to happen in the next 3 months. So usually the volatility today is less than the volatility in 3 months, right? That's the usual case. This is why this typically trades below 1, because the current volatility, the numerator, is less than the volatility projected for 3 months. However, in extreme situations, the current volatility is projected a lot higher than what is in 3 months. And guess what? Those end up usually being some of the best opportunities to buy. Just another data set here, another metric to look at in order to measure peak hysteria, just like I showed you with some of the other metrics, and how I showed you that, for instance, Black Monday, the bottom of Black Monday was the bottom for the rest of eternity. The bottom of August 24, 2015, the last Asian crisis that we've had in August, was the bottom for the rest of eternity. You can also overlap it with the VIX over VIX 3M and see these spikes when it gets above 1. If all other things align that I talked about, that is usually a good investing opportunity. Anyway, all that is to say, these are just some of the ways in which you should frame your investments, some of the metrics that you should look at. In general, you want to be buying blue chips and blue chip indices on a discount. Like, how many of you said that you would cut off a limb in order to be able to buy Nvidia below 100? Nvidia hit 91. Nvidia hit 91. Most people did not buy because they are panicked. We made 40% almost on Nvidia in a week and a half. The average return for the stock market every year is 12%. This is 3+ times more than what we would expect to make from the S&P 500 every year. We made it in a week and a half. Oh, this brings me to one other thing. Before I close out the video, one other thing that I wanted to talk about, and I wrote about this on X. Do you think that it's a coincidence that on August 5th, 2024, when Nvidia hit that 91, etc., that it was a coincidence that Schwab, Fidelity, as well as Vanguard were down? Do you guys remember that? Some of you were trying to buy because you hit me up and said that you weren't able to buy. Do you think it's a coincidence that these platforms were shut down, but yet orders were being filled, right? Somebody did buy Nvidia at 91. I ended up buying it in like the 95 range. People did pick up Nvidia at 91. Most likely these were over-the-counter orders or something. But do you really think that it's a coincidence that the best buying opportunity all year, it was the single greatest buying opportunity of 2024, that all these online brokers, Schwab, Vanguard, Fidelity, were actually down? If that doesn't tell you that that was a buying opportunity, right, that big money would rush to buy cheaply and ice all the retail traders out, then I don't know what to tell you. Anyway, traders, this is not how to time the bottom. This is, again, a video on what to look for and how to keep calm and not be scared when there is mass hysteria in the markets. Your mind should be really geared towards where can I find an asymmetrical opportunity now? What can I buy here that would give me the biggest opportunity while everybody is panicking? I get that it is scary, and I can appreciate everyone having a different monetary situation, right? If you're in need of cash, you're not going to be thinking of these things. I'm merely talking about the people that actively year round are looking for an investment, and they miss out on these times because they are afraid. You are not going to time the bottom. There will be times when you employ all these data sets and you buy and the market does keep going down slightly more, but you have a much better chance than someone that doesn't buy the fear and holds and waits for their portfolio to get back to where it was before, especially if now we're talking about bear markets, right? In this case, we were only talking about a pullback or correction, which we've so far identified correctly. You know, in bear markets and corrections and pullbacks, if you just wait for your portfolio to get back to all-time highs and you don't do anything during the times of max panic, you are going to be waiting a long time versus someone that actually buys the panic and is able to profit very shortly thereafter. Hopefully you got something out of this. The stock market is, in my opinion, the greatest wealth generator. If I bought property, there's no way that I'm making 40% in 2 weeks. There's just no way. I'm not knocking this, okay? So don't at me saying, oh, but property. No, I'm just saying that there isn't. We have access to the greatest wealth generating tool that has, you know, over 100 years of history, so much data compiled. Use the data to your advantage, guys. Use the data to your advantage. Don't be scared. I only focus, my personal strategy only focuses on blue chips and blue chip indices during the panic. That's what I want to pick up because those things rarely go on a fire sale. Anyway, traders, let me know what your favorite concept was. Let me know if you got something out of this. Put it in the comment section below. If you have any questions, put it there too. I try to answer every comment. If you have disagreements, I would love to read your data and would love to see your refutations. Subscribe to the channel. Sign up for the free mastermind if it's before September 1st that you're watching this. Hit that notification bell. Stay safe out there, traders. Peace.